Quick tip, greed and fear are closely related and they're usually involved in every single bad decision we make.
Sure they are.
So when we go forward, this is our inaugural, is that a word? Inaugural episode,
Yes.
Right? We need to make sure that everything that we do is not a decision that's made out of fear. We're not doing it because we're scared.
Right.
Okay? And when we get into a trade, we can get into some scary situations, so we can't respond out of fear. And we can't respond out of greed either.
Right.
Because we see the money rolling in and then we attach ourselves emotionally to it and we make stupid decisions. So that's our quick tip for the day. Hey everybody, my name is Jimmy. This is Tanner. This is the first ever episode of the Investing the Right Way podcast. If it's a little strange at first, that's because I usually don't ever have a co-host. In fact, most of the people coming on this will know me from my other show, which is a photography related podcast, has nothing to do with investing at all. And now I'm actually having to sit across from somebody and have a conversation. I usually just have it, with the camera. So we're going to talk about a few things on this show, all right? And the first thing we're going to talk about is why we're even doing this. And so I want to jump into that, but the other two things that we're going to talk about is our core rules. We're going to talk about 3 core rules that guide our investing, and there are many rules that will guide our investing, but we're going to talk about 3 core ones today. And then lastly, we're going to talk about the difference between stocks and options, because ultimately we want to get to where we're investing in options, we're trading options because we feel that has the most profit with the least amount of risk.
That's right.
Okay, because there's like 4 million different things you can invest in the market, and we're not going to do any of those things, at least not now.
Not now. That's right.
Okay, so we need to talk about why we're even doing the show. And I guess this really comes down to me, because you were involved, investing in your own life, and I'm doing my own little thing, and we're having conversations because we know each other. And then I had this, light bulb moment. And the light bulb moment wasn't, hey, we need to do a podcast on this. The light bulb moment for me is I need to do something to fix my financial situation. Okay, I really honestly don't believe, and everybody that I've talked to in leading up to this first episode, I really don't think, I don't think this country has 10 years left in it before we are financially bankrupt.
Unfortunately, it's most likely the case.
I think we're almost to the point of no return.
Yep. Sure.
And I don't see any elected official on either the donkeys
Right.
or the elephants that look like they want to do anything to correct it.
Right.
So unfortunately, in my own life, I've not done anything to prepare for my future. I hate to admit this, but I don't have a nest egg saved up for emergencies. I don't know what to do about health care. That's all, the laws are changing with that, and that's kind of up in the air. I don't know how I'm going to pay for it, but it's went through the roof.
Yes.
I can't afford it based on my salary now. I have debt up to my eyeballs because I've made stupid decisions most of my life. I have no inheritance to hand off to my children. I'm not prepared for any type of situation that may come my way. And so now I'm looking and I'm reading the tea leaves, as it were, and I'm seeing, I don't think we have 10 years left in us. We keep raising the debt ceiling. We keep borrowing money like at the rate of $1 million a minute.
Right.
I can't fathom that. We as a country are borrowing $1 million a minute, not spending, borrowing.
Right.
Okay, more than we earn. That's just insane. So then I have to do a lot of Dave Ramsey stuff in my life right now, because it's too late for me. The problem is I don't have significant enough income in my life in order to try to do those things to meet that timeline of less than 10 years. I think it's far less than 10 years, but it's less than 10 years, whatever it is, 2, 5, 7, I don't know.
Right.
So I've got to do some things in my life to earn money now and then dedicate that money to doing those Dave Ramsey sorts of things, to eliminate debt, and put money aside for emergency and tend to my future. So that's why I've turned to you, you're the authority on this.
There's a way that you can make enough money to be able to do that, everything that you're wanting to do, and it's just by learning a few techniques, a few rules, and then having enough patience and not allowing fear and greed to get involved. And if you learn those few rules and are willing to operate by them, you can make money on a regular basis in the stock market. And we're not talking about a little bit of money. There's ways where you can make a lot of money.
Okay. But now we're not preaching a get rich quick. I think everybody knows.
No.
Everybody knows you can make money in the market.
Well, sure, you can.
Right. It's just how. And what about the times when we lose? Because we will lose. Okay.
Yeah.
So we have to prepare for those times as well,
through
right?
good money management.
That's right.
You don't put everything into one trade at the same time. And based on the amount of risk involved in the trade, you'll use only a small portion of your money or you'll use a whole chunk of it. And we are going to teach you how to look at the situation and be able to determine what kind of situation it is, so that you can decide how much money you're going to want to risk, because you literally have to have risk in order to have reward. It's a biblical principle. It's a principle that I've seen play out in my life. It's a principle that I've watched play out in other folks' life. And so if you want a return, you have to take the risk. And a risk that I'm willing to take and have been taking for some time is with the stock market.
Okay. Now, in order to do this, though, to minimize the amount of risk, we've got to follow some rules. Right?
That's correct.
So this is why I'm doing this, because I feel a financial ticking of a time bomb. You know, it's going to explode. If we, in a worst case scenario, we go bankrupt like Greece. Right. And that's a situation that I just don't even want to think about. That's a worst case scenario. And I think, unfortunately, most Americans, most of the people listening to the show are going to think we're headed there.
Right.
Okay. So I have $2,000 to spend. Okay. So we're going to take my $2,000 and I'm going to report to these people exactly what stock or option or both that I invest in. We usually don't do stocks and options. We're making an exception to the rule here just for the purpose of this show, because we know a lot of people don't have the capital to get into options, because you probably need a minimum of $500 to get started with options. Okay. So a lot of people will just follow these same rules for stocks and build that seed pile up until they can get enough to do options. Okay. So we're gonna break our own rule here. All right. We're gonna invest in one option where everybody ultimately wants to go, and then we're going to invest in a stock, which is what the people with the smaller budgets will invest in. Okay. And then we're going to report to those. So if I invest in Apple, okay, I'm going to say exactly how much I'm investing in Apple, how much I make on Apple, or how much I lose on Apple, and we're going to report it back on the show.
Sounds good.
Which leads me to a little special program that we installed. It's on the website. We call it Instant Alerts. And what that is going to do is, because when you watch this show, it's already 2 or 3 days past.
Right.
Okay. So in order to get near real-time involvement in the trade that we're making, Instant Alert, when you sign up for that, will send you a text message to your phone within 2 minutes of me actually making a trade. So if I get into a trade, I'll send out a text alert to those people that are subscribers and say, this is the trade that I went in.
Right.
And as soon as I get out, within 2 minutes, you'll get an alert that says, I bailed.
That's right.
Okay. So now that's the only service that we charge for, because I got to pay money for it. You got to pay money for it. So it's $50 a month. More information is at the website, but we give it a caveat in that we explain, anytime that you want to bail out of it, we'll give you the last 30 days back. So, use it for as long as you want to. And anytime that you pull the trigger and say, hey, I don't want to do this no more, we'll take your last payment and refund it to you. Which leads me to, we have, I think, 4 or 5 people that have signed up because we're not invested in the market as soon as we had hoped. And we're going to talk about that in just a second.
Right.
I'm going to refund those people. So if you've already signed up for it, if you're one of the first 4 or 5 people, contact me and I'll refund your money. Okay, because
Wow.
I want to make sure they get their money's worth. All right. So that goes into, I'm looking at my notes here. Now we need to talk about our three rules, our core three. There's many rules that we're going to talk about,
Yes.
but we got three core rules. What's the first core rule?
First core rule is fundamentals.
And that means, are you talking about like charting the stock?
No, I'm actually talking about what shape the company is in that we're looking at.
Okay.
And the reason why we look at that is because if the company's not a fundamentally sound company, we're not going to invest in it at all. So we look at fundamentals, overall fundamentals, and what we're looking for is profitability and increasing profitability over time. So earnings per share, we want to see it increasing quarter after quarter, or at the very least, year over year. So the last quarter from last year is compared to this quarter from this year, and that is one of the things that we're looking at in order to determine whether a company is worthy of the money. Because the last thing we want to do is invest in something like Enron. Enron was one of those situations where they were cooking the books, and for people who were following them really closely, they actually were able to get out before losing a whole lot of money.
Because they were tracking what
Because they were
the company was
tracking what the company was doing, and they were looking at their financial books and saying, you know what, this doesn't make sense.
doing. You know, a stock that we've recently looked at is Netflix.
Uh-huh.
And 6 months ago, Netflix would have been a great stock to get into.
Absolutely.
Everybody's still dogpiling on Netflix, but that's out of our list of consideration.
Right.
Because the fundamentals of the company, it's not making the money.
It's not making the right kind of money
Yeah.
for the amount of investment.
In fact, they keep making less money
That's right.
as they keep reporting.
That's exactly right.
Okay, so that makes sense. So where can I get this information?
You can get fundamental information from several websites, but we use Yahoo Finance.
Okay.
Yahoo Finance, you type a stock ticker in, and the stock ticker will bring up all the financial history that you really care to. It brings up more than what you can possibly digest.
Okay. But it includes, we saw a P&L statement, basically, profit and loss statement for a quarter.
That's right.
You can also look and see who's running the company, how long they've been there, where did they come from, how much stock do they own, what are they doing with their own stock.
That's right.
With the company?
Are they holding it or are they selling it?
Right.
That sometimes is a very important bit of information.
If they're dumping their own stock,
That's right.
That could mean something.
Yep.
Okay, so another website was Google, Google Finance.
Yes.
Is that what
Google
it's called?
Finance is a good resource as well. We use some of their charts. If
Okay.
you want to keep up to the minute, absolutely up to the minute. We use their charts in order to stay up 1 minute at a time. And if you're new, that's probably what you're going to do. You're going to want to watch it because when you have real money invested in the stock market, now you have that that excitement and everything
Pressure?
going to pressure. Yes, because the last thing you want to do is get caught in something.
Right.
Well, after time passes, you're probably not going to want to watch it that often. But starting out, you may want to.
Okay. Give me another rule.
Another rule is good technicals.
Okay.
Technicals essentially.
This is the charting stuff.
This is the charting stuff, and everybody has seen it. You've seen the stock market go up and go down and go up and go down and go up and go down. Well, the technicals are what we use in order to determine when it's going to go up and when it's going to go down.
Okay.
Everybody has heard you can't predict where the stock market is going.
Sure.
And all I got to say is phooey. That's a big lie. They predict it all the time. I can predict when it's going to go up and when it's going to go down based off of the rules that we're discussing right here. The technicals are literally drawing lines on a chart and looking for patterns. And it's really simple. It's not difficult at all.
And to break this down a little bit is, there are people with deep pockets
Yes.
that are investing in the market. And we call them market makers because they are literally controlling the rise and fall of not only individual stocks, but the market in general.
That's right.
And we can look through, with certain software, we're using Worden, right? Worden, it's a link on the resources tab at the website. You can actually see the volume in a stock or the market in general or a sector of the market by the minute.
Right.
You can see how many trades are happening a minute.
Right.
And those kinds of things can indicate to us, when are the big dogs investing? Because they usually tend to dogpile on one another. Okay, and all we're doing is riding their coattails. Now, you and I don't have the money to manipulate a market.
No.
We don't. We can't manipulate a stock. We can't manipulate the market. But these guys can.
Yes.
Okay, and so when they dump billions of dollars into stocks or out of stocks, the market increases or decreases, and it's that motion. In fact, I've got a picture here I'll put on the screen. This is a typical stock, and you can see what I mean by it goes up and it goes down. And the only thing that Tanner's talking about is we're going to draw a set of lines. We're going to draw a line across the peaks of this stock, okay? And as we draw the line across the peaks, that line is referred to as resistance line. Because usually when we hit that line, we're going to start turning back the opposite direction.
Right.
And we also draw a line across the valleys, and that line across the valley is referred to as
support.
Okay, because when it hits that, it usually bounces back up. So that's very basic stuff. Okay,
Right.
and we'll get into more detailed analysis of this because you were showing me dojis and shooting stars and all these little names that were really cool information to have, but you require over time.
Sure.
So, but we'll go into that. We went through how the company's doing, and we went through the technicals on graphing and charting.
Right.
Okay, and the third fundamental is?
Market tone.
Okay, and what do you mean market tone?
What we mean by market tone is literally taking an overall view of the economy,
okay,
and not just what the government's saying about it, but how it's perceived by the public.
Oh, that's important.
Because interpretation is everything.
Right.
So even though the economic news may be good, the stock market may fall on the news. And it's baffling.
Right.
You go, well, why in the world is the stock market headed down? Well, the reason why is because the big boys, the people who have really deep pockets, they already inflated the price in anticipation of the good news.
Now, this is something you were pointing out to me in other conversations. By the time we hear this news, it's usually over.
That's
it's
correct.
too late. So these guys are already responding to things that we haven't heard about yet.
That's right. Because
Okay.
they either are inside or they know somebody, or because they've been doing it long enough, they can anticipate it. So what we're doing by using market tone, we're taking the overall picture of the economy, and not just the U.S. economy, but the world economy, world events, and we're encapsulating that into one picture.
Okay.
And by putting it into one picture, we're saying, okay, well, the overall market tone is good,
Okay.
which means that the market is most likely going to continue the pattern that it's in,
Okay.
which right now it's been trending up. If the overall market tone is good, it's going to continue in the pattern it's in. It may have ups and downs even inside that upward pattern, but the overall trend is up.
Okay.
Down news or negative market tone means that the stock market is going to do something different.
Okay.
Depending on how it is interpreted by the public. In other words, depending on how it is spun in the news and then interpreted by the public. So just because you have negative news doesn't necessarily mean that the market is going to start taking a nosedive. It just means that we're going to stand back and we're going to look at it and wait for the market to tell us what to do on negative news.
Patience.
That's exactly right, patience, because the one thing you don't want to do and the one thing you don't want to feel like you have to do as a stock trader is be in the market all the time.
Okay, now this brings up why we've suffered a delay. For those that have followed along with the show even prior to there being a show, that have followed me over from the other one, they're like, what's taking so long? And one of the legs of our stool was missing.
That's right.
So our three-legged stool is how is the company doing, the market tone, what you just talked about, and the technicals, that whole charting thing.
Right.
And one of our legs was missing, and our technicals weren't lining up.
That's right.
Okay, we were due and scheduled according to previous trends to start a decline.
Right.
That hasn't happened. We've had some things in the news that have manipulated that. We've had a new Fed chief get what do you call it? They approved or whatever.
Right. She had hearings.
She had hearings, right? A confirmation hearing.
That's right.
And the new Fed chief has basically said or indicated in her responses that they're going to continue, the Fed's going to continue putting $85 billion into our economy a month. And the stock market likes that.
Right.
So it's shooting up to higher levels than it's been in quite some time.
That's right.
At least, well, ever.
Right.
Ever.
All-time highs.
Yeah, all-time highs. Dow and the S&P 500.
And NASDAQ today.
Okay, all new highs across the board. And so we're due for a turn,
Right.
But because it's not turning like it's supposed to, and because the volume is going up, well, the levels are going up without the volume.
That's correct.
Okay, and we have to kind of talk about that because you and I, when we get in and we collectively make trades, there's a certain amount of volume associated with that. Hundreds of thousands of people are trading, and there's a level of volume that's manipulating the market. But the big boys, the guys with the deep pockets, they're not doing anything.
That's right. They're either holding what they've already got or they're staying in cash.
And since they're the ones who dictate the change in the market, we're waiting for them to initiate a sell-off.
That's correct. Or, here's the other side of it.
Right.
They may actually begin to purchase. And that's the reason why right now, because we don't have really deep pockets and can't afford to lose everything that we've got,
Right.
That's why we're standing in cash. We're going to stand in cash until we see the indicator that the big boys, the people with deep pockets, have decided to trade. And that will be indicated by volume. And so we'll be watching volume and watching all these indicators to wait and see what they're going to do. And the second that they make their decision, that's when we're going to jump on and say, okay, we're going to ride their coattails because they're big enough to pull us
And
along.
we're anticipating that's going to happen within the next 2 weeks.
Yes.
They're not going to hold on to that cash
No.
and stay in those positions that long.
No, because the big boys, unlike most of us,
Right.
and unlike me several years ago, the big boys can make money when the stock market's going up and when the stock market's going down.
But it needs to go somewhere.
It has to go. The only time they don't make any money, period, is when it's going sideways, which is what it's doing right now because we're in a moment of indecision. So over the last few, well, not few weeks, but a few days, a little over a week, it's gone almost sideways. Literally,
Yeah.
you can look on the stock chart and see where it hasn't made any significant move up. It hasn't made any significant move down. And that's what we're looking for, a move up or move down on high volume.
Got it. All right. So that's why we haven't been involved in the market yet.
Right.
One of our legs was missing off our stool.
Yep.
Okay. So anytime we have a missing leg, we don't invest. And I'd like to give some examples. And these are examples that you gave me as you're trying to tutor me. Tutor? I like tootle better. So as you've been trying to tootle me, these were examples that you gave. The last thing we want to do is involve our gut in making a decision.
That's right.
No feelings, no emotions. Okay, we need to rely off those three-legged stool. And an example of when your gut would have made you a lot of money. Here's a great example. Okay, Apple just recently came out with the iPhone 5C and S model. The
Right.
S being the most expensive, with the most profit in it, and the C a step down, a cheaper version. Okay, and while people were standing in line to get this thing, some talking head on some reporting show about the stock market was asked, do you think Apple releasing both a more expensive model and a cheaper model at the exact same time was a wise decision? Now here's where my understanding of retail come in.
Right.
Absolutely, it's a great decision.
Right.
I know this, okay, but I have experience in that industry to know that it's a right decision.
Right.
This talking head just deals with stocks, okay? They don't really know. They just look at quarterly statements from company. And this guy made a decision that, well, he thought that it would be a bad call. It was going to be a bad call, and when the numbers came in Monday morning, Apple was going to be very regretful that they did this, and it was going to hurt their bottom line because the vast majority of people were going to buy the cheaper model where there was less profit, and that was going to impact their bottom line. That's what he said.
That's what he said.
He said that on Friday, the stock plummeted $100 a share overnight.
Right.
Okay, and if you were in the trade, you were panicking because you just watch it all evaporate. Okay, now my gut and my understanding says the guy's an idiot. I want to buy more. It just dropped $100 a share. I know what's going to happen Monday.
Right.
I'm sinking everything I got into it, and I'm going to make a pile of cash on Monday. And when Monday rolled around, I'd have been right. I'd have been sitting pretty. My gut would have paid off. But let's give an example of when that wouldn't have worked. Facebook releases their initial public offering. They go public for the first time.
Right.
When it comes to social media, Facebook, the blue F, that's what everybody thinks of. Okay? It was a no-brainer. Here's a company that's being led well, is making a lot of money, okay? Is got name brand recognition for that market. You would expect that to be a great stock. Your gut says that's going to be an awesome purchase. When it all rolled out, though, it's been tanking ever since.
Right.
Well, it started to bounce back, but you watched all your money leave, and for months it stayed gone, and now it's starting to try to build back up. And why wouldn't we have invested in that? We were missing a leg.
Right.
We had no technicals to go. We can't look to see what the stock has done in the past because there was no stock to look off. We could never go into an initial public offering using this three-legged stool mentality.
That's correct.
Okay, so
Because it would be a news play, and we do not participate in news plays because the big boys, they trade on rumors.
okay.
When the news comes out, they buy on a rumor and they sell when news comes out because that's when everybody else starts jumping on and they've already made their money.
All right, so let's see. We talked about that. We talked about that. We talked about that. All right. So I think we're done for this particular show. All right. So I've got $2,000. You're going to help me tie in. We're on a holding pattern now, waiting for the market to tell us what it's going to do.
That's right.
It's either going to go up and establish new trends, or it's going to fall back to its old ways. It's going to decline and start moving down.
Right.
We're going to invest in an option as it moves down.
That's correct.
Because we can actually make money on stocks and options as it moves down. And that leads me to the final thing that we need to talk about. The difference between a stock and an option. Because now, okay, I understand what a stock is.
Right.
I'm a company, I own stock. You buy a stock, it's like you're investing in me.
That's right.
Okay. I'm not really sure what an option is. Okay. Now I've watched the movies. The bad guy does something to a company, the stock tanks, and he makes a quadrillion dollars and goes and retires on a beach somewhere. But I don't understand how a stock could decline and the bad dude make money.
Okay.
So what is an option?
Well, the best way to describe an option is it's kind of like stock where you can trade it.
Okay.
So you trade it and you buy it and hope that it does what you're wanting it to do, which most likely it will using the system. And then you sell it for a profit. So just think about it this way. If you own a car, your car is the stock. We already know that the analogy is kind of flawed a little bit because cars go down in value and they rarely ever go back up. But just think of the option as the insurance that you purchase to insure the value of the car.
Okay, so the stock is the car. The insurance is the option. So what I'm trading is an insurance policy.
That's correct. In other words, If I am anticipating the stock to go up in value, then I am going to buy what we would call calls. It's a call option, meaning when it goes up in value, I can call the person who wrote the insurance policy up on the phone and say, hey, by the way, I want you to make good on this policy.
Okay.
So I get to buy the stock, if I wanted to, at a discounted price.
Okay, so let me give you an analogy.
Okay,
Make sure
very
I'm clear. Okay, so we'll be at extreme. Let's say I buy a stock and it's $50 stock, $50 a share, and whatever, it goes up overnight to $100 a share.
Right.
But I owned an option or an insurance policy at the $50 mark. I could then force the person that wrote it to give me that stock that's now valued at $100 for $50.
That's correct.
And then I could turn around and now I have a $100 stock, or valued at $100, but I only paid $50 for it.
That's right.
And then I could resell it and take the profit.
That's correct.
Okay.
But we don't take it that far.
Okay.
What we're doing is we're just literally trading only the insurance policy. So we'll buy it, we'll let that stock go up in value, and then we'll turn around and we'll sell the insurance policy that is now worth a whole lot more because it's insuring a whole lot more profit.
I got you.
We're going to sell it for a profit. And the reason why we do the options is because we can spend a whole lot less of our hard-earned money to get involved in a trade that is worth a whole lot more money. So we're risking less with the potential for a larger reward.
Okay, so then one of our rules that we haven't really talked about is we're looking for a stock that has a 15-point swing.
That's right.
15% up, 15% down, that's its normal movement pattern. And you said we could make more than what that stock, so if a stock, say, was $50, and it moved to, I don't know what 15% of 50 is, but we'll call it 65.
Okay.
We'll call it 60.
That'll work.
I don't think my math's right, but let's say it moves to $60. The option for that $50 stock would probably cost me how much, roughly?
Well, using the information you've given me, it's going to cost you about 10% of whatever the stock is.
Okay, so if it was 50, it'd cost me 5.
It costs you close to 5.
Okay.
Now, when it goes up as far as you're talking, you have the potential of being able to make that amount of money on top of the option. And there's a whole lot of complicated math that goes into it because the market determines how much that is worth. In other words, if I'm selling you something, you have to agree to buy it for that price.
Right, okay.
But we have additional rules which we'll cover in other classes that will help guarantee that when you're ready to sell something, there's somebody there willing to buy it.
Okay.
And as long as there's someone there willing to buy it, remember, they're the ones who wrote the insurance policy.
Yeah.
Just think about it this way. If the insurance company knew that it was going to cost them a tremendous amount of money to continue to insure something, they might pick up the phone and call you and say, hey, by the way, we want to buy it back.
Gotcha.
Well, that's what's happening with an option. Now, we've covered the upside for options, but there's also a way to make money when the stock is going down through options.
So there, and that kind of option is, the other one was called a call. This one is called a
put.
Okay, that's weird names.
Yeah, it's kind of weird. I don't know exactly, but you can think about a put this way. If something is going down, you have the opportunity to put it down.
Okay.
Okay, so put is down, call is up. I'm going to call somebody up. I'm going to put something down.
Okay.
And so that's a way to keep track of what kind of option you're wanting to look at. But in a market where the underlying stock that the insurance policy is written on, where the stock is going down, a put option actually goes up in value.
So if I bought a put for $5 on a $50 stock, okay, and the stock moved to $40, that $5 put option could be worth
it could potentially be worth, let me see if I can do the math. It could be worth up to $15 or
Oh, wow.
$5.
That's a 200% markup, isn't it?
Yes.
300%. That's a
Well,
300%
yeah,
markup.
something like that. But again, it all depends on a lot of the moving parts where, okay, an option is determined on two different values, on intrinsic value and on time value. Again, I'm getting into a whole lot more than what we
gonna
need
go
to
into all
right
that,
now.
yeah.
But it depends on whether you're following the rules that we're going to teach you concerning an option later, and whether there's a market out there for it. Again, we'll cover that, and we'll show you ways of guaranteeing that there is a market out there for it. And so once you take all those variables into consideration, yes, you can make a tremendous amount of money on a very small move in a stock by just simply holding the option.
So a 10%, 15% movement in a stock could be 30, 40, 50, 60, 70% on an
Yes.
option. So that's why we want to invest in options.
Right.
But there is a significant risk because on a stock, if it starts to devalue, I got lots of time to be able to sell that thing off.
That's right.
On an option, I don't have a lot of time.
That's right.
So if that 15% movement went in the opposite direction, I could lose half my money just like that.
That's right.
Or it could go to zero, conceivably zero.
That's correct.
But we're going to establish rules to help minimize that risk.
Uh-huh.
Okay. So that's why we want to get into options,
That's right.
because there's more profitability. Okay, there is more risk, but there's more profitability. We'll take steps to minimize the risk. Okay, and we're going to talk about all of those next time.
All right, brother.
Okay, all right. So this concludes our first episode of the Investing the Right Way podcast. This was just loosely to get us your feet wet into what we're going to do. Remember, the Investing the Right Way website, investingtherightway.com, has the instant alerts where you can see instantly what we're going to do. And hopefully before next week, I don't know, it depends on how things go, but hopefully before next week we'll be able to actually invest in a trade. And if you're on the instant alert program, you'll get the notification on exactly what that is at the moment that we did it. Now, I'm not stupid, okay?
Right.
I'm putting that out there so that people can follow it along. But I know some people are going to just do what I do.
Right.
It's just human nature.
Right.
They're going to see me go into something and they're going to do what I'm going to do. I'm going to tell you right now, I'm going to lose money. I'm going to lose money. Even following the rules,
That's right.
you're going to lose 1 out of 10 times. Okay? So if you follow me into a trade and you lose money, don't be mad at me, because there's no way to 100% guarantee that you will always make money.
That's correct.
So, brother, I'm excited.
Yeah, me too.
Okay, so next week we're going to talk about hopefully getting to a trade. We'll explore some more of those rules governing how to purchase an option, that guide us how to purchase an option. And then we're going to talk about some goal setting, because that's really important too. We just don't start trying to make money with no goal of what to do with it when and if we get it. And so we're going to talk about some goal setting. That's going to be very important for later on how we continue to make money. Okay?
All right.
And I think I covered everything. And if I didn't, we'll catch it next week.
Okay.
See you next week. Peace out. Bye.
Nice to meet you.